Monte recently did a really interesting piece on his Substack about Square. Monte, you want to touch on that a little bit?
Yeah, just a brief highlight on the company and what I wrote about. I did a little bit of a deep dive on Square, a little bit about the circumferencing fintech industry, a few competitor analyses, and kind of took a macro viewpoint on where I see the fintech industry going, along with small regional banks. And I got to tell you, I have a very bearish outlook for these few firms. Just looking at a few things like their clientele's credit quality, the size of their clientele, and just the general business outlook of these smaller firms that they lend out to. It just does not look pretty for the rest of the year. I'll tell you that much.
Yeah. Yeah. And if we look at the technicals as well, which I guess I'll share that right now and see what that looks like. This is an experiment for us because we've never done screen share in a Zoom call. So I don't know how it's going to be for the viewer. But if we look at the technicals here for Square in particular, but the way these are all usually posted in the Discord as well. Worst technicals I've ever seen for this company. Had it to $16. Some technicians have this going to 15 as well, I've noticed. Some other practitioners of Elliott Wave analysis. And this is not just for Square. If you look at other participants like PayPal, like Monty suggested, the technicals seem to be aligning with the fundamentals pretty well here, and these companies do not look solid at all. For full disclosure, I am currently shorting the stock due to the combination of the thesis. I'll go ahead and stop sharing that. And
Yeah, full disclosure as well. I too have a couple of puts spread out on Square.
what's your expiration for those?
A couple of them in January, a couple of them out to April. So I'm giving
Oh wow.
myself a little bit of time, a couple, or I guess earnings call to kind of figure out if it's going to materialize or not sooner than later.
Yeah, I think it's going to be a rough 2024.
Oh, absolutely, absolutely. And just reviewing a lot of this data, it's not necessarily public through Square to where, or I guess Block, in which they don't really report on their clientele too much or really their lending business too much. And I kind of got flagged on a piece I put out on Seeking Alpha about it because I raised this concern to where Block does not report their rates on their loans. So they charge a fixed fee on each of their loans that they loan out to small businesses as well as consumers that get amortized with every cash exchange. So if you were Josh and Co. and you took out a $10,000 loan, every time I paid you a $20 subscription, you would take or Square would take out a small portion of that $20 to cover that loan. So it's a very kind of fishy method of reporting in which you don't really know the quality of the loan, the quality of the lendee. You just know that these loans exist and that's about it.
That's
And
really
another,
concerning,
oh yeah,
actually. Yeah, it's really
very, very
concerning.
concerning.
Yeah.
And if you think about it, a lot of small companies, a lot of medium-sized companies, a lot of private companies, they don't get these credit ratings that larger firms do, especially publicly traded firms. So you can't really know the quality of their book without really understanding, I guess, how small business operates and runs. The other side to it is that they don't report FICO scores for their consumers either. And I had to do some kind of what's the proper word for it? Just building my own spider web of information by looking at other firms. So SoFi, they report their FICO scores of their clientele. And I found that very interesting, in which, granted, credit cards is a very small portion of their business. It did paint some color into the picture that I was trying to draw, in which I think it was 55% of their credit card lendees have a FICO credit score under 700, and 13% of your total credit card users have a FICO score under 599, which is
And
like, wow.
Yeah. So, and I saw that you were conversing with one of the Discord members about that as well, and they said that they had a limit or a minimum that was above that. But so which I immediately read that and I thought, okay, are they consistently up? Has there been degradation in the quality of their clientele? Has their clientele started to suffer and miss payments, and that has caused the destruction of their credit score? Because when they originally applied, they're above, what was it, like 750? I think that member said is what their minimum was for the loans, and so I'm assuming that the degradation there and them falling so far behind, 13% being so poorly off, is because of that. The consumer started to hurt more. Is that a fair estimate of what's probably happened to
If I
them?
had to guess, they're chasing yield. So, a bank doesn't necessarily make money or the most money by lending out to their highest quality creditors. They lend out to the lower quality in which they can require a higher yield on those loans. So, like when you compare high yield fixed income to investment grade fixed income, you're going to see a couple point spread between the two that will essentially say, hey, I'm going to get paid more for taking on more risk. So that's my presumption on what they're doing. It's not a good thing, it's not a bad thing, but more so, um, it's more tied to the size of the clientele and the type of clientele that they're working with. So
Okay.
one of the comparisons I made in my article, and this is a company that I researched a few years back, Citizens Financial Group, CFG is the ticker. Looking at their loan book, it was something like, God, I can't remember off the top of my head. I think it was like 85 or so percent was above that 680 credit score. So just comparing the bulk of theirs at that higher end, whereas the bulk of, these fintech firms being at the bottom end, you kind of see that dispersion on credit quality.
Are we going to see a lot of death in fintech then, probably in 2024? Because it sounds pretty awful. I mean, is Square actually? Let me back up a little bit and talk about Square. Is Square potentially going to be facing legal issues with that not reporting? Are they not held to any legal standard? Like, can they can just not report that information? That sounds so weird to me. But again,
So yeah, I
I'm
don't
not
think they have to.
okay.
Yeah, I don't think it's a gap requirement to report FICO scores per se, but it's one of those things. So when I first started out, one of my senior PMs, what he told me was pretty much all the broken out information from the standard um, income statement, balance sheet, and cash flow statement. All the additional information is usually just stuff that analysts request over and over and over again. And the firm's like, all right, we're going to just give you that information so you don't have to ask for it every single time. So
Okay.
yeah, it pretty much helps the analyst community get to the point faster than having to, everybody request it and then sending it out to everybody.
Okay. And I
But
wonder if Square is ignoring, because certainly they're getting some of those requests as well. Have you ever reached out to a company to try to get information like that?
it's usually 50-50 with them getting back to me. Some they'll be pretty prompt about it, some won't be.
Okay.
It, yeah, it just depends on the company. And usually tech companies, it gets kind of weird. I've had a few tech companies where they outsource some of that stuff. I haven't checked on Squares, so I can't really say how they run their investor relations shop, but I know that some firms will either just ignore you or they're pretty on the ball with it with getting back to you pretty promptly.
Do you see that as a warning sign if they're not as on the ball with it?
Uh, Probably, yeah. I wouldn't be all doom and gloom about it. It just all depends on how they have their shop set up. So I remember, 3, 4 years ago, I tried to reach out to the guys at Roku to get some better color on their Roku TV channel. And I probably sent them 3, 4 emails, called them a couple times, and just nothing.
Hmm.
So it all just depends on the firm and how they run their IR shop.
And you mentioned earlier that this got flagged on Seeking Alpha. Are you saying that you were flagging something on Seeking Alpha, or someone flagged
Yeah,
you?
when I was publishing my article on Seeking Alpha, the editor flagged it that, hey, don't put that in there. So it's in my Substack, but not on the Seeking Alpha article. So I'll publish on Seeking Alpha in
Why
conjunction
would
with Substack.
wait? What was okay? Backtrack. What was the specific thing they flagged and why?
Oh, I'd have to look up that quote. I think it was just me voicing that I don't remember the exact phrasing. It was kind of something like, it raised an eyebrow for me to see that they don't publish their rates on their loans. And, I didn't necessarily say it was a bad thing, but the phrasing may have put a lean towards it, if that makes
Okay.
sense. Yeah.
Why is that
Yeah.
bad?
Uh, I think they want you to have more of a neutral verbiage and not so doom and gloom.
Hmm.
Because I usually voice in extremes to portray a certain image that isn't necessarily as detrimental as I make it appear to be. I mean, in some
Okay.
cases like this, I have a pretty strong hunch that fintech is going to take a pretty big beating in the next year. And,
Yeah.
you know, throughout the Substack, I clarify as to why pretty well. There's a few other companies that I've written about that had a pretty good analysis on why they might be taking a beating over the next year or two, just given market fundamentals and where they're at in the business cycle. So it all just depends.
PayPal's another one. Have you looked at PayPal
I
recently?
uh I did a brief high level analysis on them to get that mosaic for block. So it's not as nearly in depth as block, but very high level of them.
Okay, so let me ask you this: if these companies hit, if Stripe, I mean, sorry, if Square comes down to that $15 price point in 2024, or if you see a similar type of sell off with PayPal, are any of these companies going to be a buy for you at those valuations?
Thinking long term, I think yes. So when I was valuing block, so just to clarify for everybody else, Square is block, block is Square,
Yeah.
and I don't get why they did it. Well, I guess I get why they did it, just the web of different businesses they have, but it's just another bit of information you wish you didn't have to store in your brain. But um, when valuing block, I put a pretty hefty price to book valuation on them. I was just trying to figure out, how are you supposed to value this company? Are they a bank? Are they a tech company? Should they be kind of like a broad comparison by percentage of business that they do? So, like, would you put X amount percent of their valuation to credit card companies, X amount into buy now, pay later, X amount into peer to peer transfer like PayPal? Like, how do you exactly value this firm? So I just took kind of like a spread of percentages of book value, price to book values for a few of their competitors to come up with a 1.59 times book value per share. And that gave me a price target, I want to say, of something like $43 a share, something in that range. And if you compare it to the financials industry, so the way you trade banks is you look at their price to book value, which should circulate around one times. That's the total equity value of the bank. That's where, you should be investing at it. If you invest it under one times, you're buying at a good discount. If you're investing over, somewhat of a premium. Typically, they stay within a certain range of that one times book value. So if you look at the average for the sector, it's something like 1.03 times. To value Square, we were looking at, I want to say, very low 30s or 30 flat for a price target at one times. So it just fundamentally, it looks pretty bad for their share valuation, for their share price.
Hmm.
And if we're looking at this this disaster that you're referring to on their stock chart, and if what I'm referring to in my Substack article, that we might be going into essentially a recession on the small business scale. So I think it was Reuters that reported an article a couple months back that over 50% of small businesses believe we're already in a recession. Over 50%. These are the mom and pop shops. These are the guys that bring in a couple $100,000 to a couple $1 million a year in revenue. The small fries that aren't going to be, again, listed or have their credit rated. And over half of them suspect that we're already in a recession. This is their clientele. These are the people that they're lending out to. So if they're already wary about the economy, I mean, we have barely gotten started on what a lot of people expect to be a pretty nasty downturn. I mean, it's going to be interesting to see how this next year progresses on this basis.
All right. Well, I think that's it. Any last comments you want to give on PayPal and Square?
Yeah. As we both discussed earlier, we both have put positions or short positions on Block, and keep your head up, stay attentive when buying short positions. They can go sideways pretty fast, especially if you're shorting the equity directly. Unlike long positions, short positions have unlimited downside. So when you're making these bets, make sure you do your homework, do your due diligence. This is not financial advice. This is our opinions and the strategies that we are partaking in as investment professionals.
Yeah. Be better than Citadel. All right. Well, that's going to be it for, I guess I'll just call this a special report. It's going to be it for the special report. Thanks for viewing, everyone. Hope you found this information helpful. And remember to do your own research. We are not financial advisors.